There is a silent movement happening right now at the center of the global financial system. It is not being clearly explained on major news broadcasts, and it does not appear as an alarming headline every single day. But it is underway. The largest asset manager in the world, overseeing more than $14 trillion, has strategically altered its position regarding U.S. public debt. And when an institution of that magnitude changes direction, it is not a technical detail. It is a signal. The United States government has surpassed $38 trillion in debt. Annual interest payments alone now exceed $1 trillion. That means one of the largest line items in the federal budget today is not healthcare, not defense, not infrastructure. It is paying creditors. And to sustain this structure, the Treasury must continuously issue new bonds. The problem is that structural demand for these bonds is no longer what it was in previous decades. The Federal Reserve has reduced its role as the dominant buyer, foreign central banks are diversifying their reserves, and investors are demanding higher yields to hold long-term bonds. When supply increases and demand decreases, yields rise, and higher rates do not remain confined to the corridors of Washington. They spread throughout the economy. The 30-year mortgage rate rises. Auto financing becomes more expensive. Companies pay more to raise capital. Consumption slows. The cost of money increases for everyone. This is not a political opinion. It is market mathematics. In this environment, large asset managers begin reducing exposure to long-term bonds and reallocating capital toward real assets. Infrastructure, energy, private credit, and productive assets gain strategic importance. The logic is simple. A government bond pays a fixed coupon that can lose real value in an inflationary environment. A toll road can adjust its pricing. A port can increase fees. A pipeline can pass through costs. A data center can benefit from the explosion of artificial intelligence. Real assets have pricing power. Bonds do not. For decades, the classic 60% stocks and 40% bonds model was considered the gold standard of diversification. The idea was that when equities declined, bonds would provide protection. But when stocks and bonds begin falling simultaneously, that negative correlation stops working. Investors realize that the stability once promised is no longer guaranteed. And when the largest asset manager in the world signals this structural shift, the entire market pays attention. It may seem distant from everyday reality, but this transformation reaches ordinary citizens quickly. Mortgage rates are directly tied to Treasury yields. If major buyers step away, yields rise. That makes home financing more expensive. Fewer families can afford to buy homes. The rental market expands. Institutions with deep capital reserves begin acquiring entire neighborhoods for rent. Ownership shifts from individuals to corporate balance sheets. At the same time, the so-called private credit system continues to grow. Instead of relying on heavily regulated traditional banks, companies increasingly raise capital directly from large funds. This system operates with fewer regulatory constraints and offers greater contractual flexibility. But it also concentrates power. Whoever controls credit controls strategic decisions about expansion, investment, and corporate survival. When pension funds and retirement accounts allocate capital to these vehicles, risk shifts away from banks and ultimately toward the end investor. Another central pillar of this reallocation is energy infrastructure. The artificial intelligence revolution depends on data centers that consume enormous amounts of electricity. Without stable and abundant energy, digital expansion cannot occur. Electrical infrastructure, generation, transmission, and storage becomes strategically vital. Controlling energy means positioning oneself at the foundation of the new technological economy. At the same time, institutional interest in scarce assets is rising. In an environment of persistent deficits and monetary expansion, investors seek protection in assets that cannot be created by political decree. Gold, infrastructure, productive land, and even digital assets enter that conversation, not necessarily as speculation, but as structural hedges against sovereign risk and purchasing power erosion. For 40 years, the world became accustomed to a cycle of falling interest rates, accelerating globalization, abundant credit, and controlled inflation. That cycle favored financial assets and encouraged leverage. But if we are entering a period of structurally higher interest rates, regional economic blocs, and greater volatility, the old playbook may no longer function the same way. Passive strategies heavily dependent on liquidity and sovereign bonds may not provide the same real protection. This transition does not mean immediate collapse. It means regime change, a shift in how capital seeks safety and return, a shift in the relationship between public debt and productive assets, a shift in the strategic importance of energy, infrastructure, and scarcity. For the individual investor, the challenge is not to react with panic, but to understand the structural direction, reducing exposure to high-cost debt, diversifying income streams, studying assets with pricing power, and understanding where institutional capital is flowing becomes more important than following surface-level narratives. Money always leaves footprints, and tracking those footprints provides insight into the future. When large asset managers reduce exposure to sovereign bonds and increase allocations to infrastructure, energy, and scarce assets, they are responding to mathematical incentives. It is not ideology, it is not conspiracy theory, it is global-scale risk management. We may be witnessing the end of an economic cycle that lasted decades, and the beginning of another with different characteristics. Liquidity may become more selective. Interest rates may remain elevated for longer. Real assets may gain prominence. Global diversification may shift from optional to strategic. The question is not whether change is happening. It has already begun. The question is whether each investor is willing to observe the signals and adapt their strategy before the effects become obvious. Because when structural transformation becomes a headline, most of the movement has already taken place. The financial game is evolving, and understanding that evolution may determine whether you simply react to the coming decades or position yourself consciously within them.